Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is the starting lineup for your 3 in 10 podcast for October 17th, 2025, being recorded at 4 p.m. Eastern Daylight Time. Number 1, in the foothills of a bubble. We just published a strategy report with that title yesterday. We're going to get into some of the key takeaways from that report. Number 2, JPM earnings, a colossus that continues to produce prodigious revenue and earnings growth, and told us a few things about consumers and credit along the way in their third quarter earnings call. Number 3, the Fortress AGM, or we'll just call it credit conference. Fortress is focused on value, protecting the downside, and intense monitoring of their individual positions. We think the timing of this conference was fantastic given the deep concerns about what's going on in credit today, which we think are overblown. But back to number 1, in the foothills of a bubble. We see the drivers of this emerging bubble. And remember, we entitled this the foothills of a bubble, meaning we're in the early stages of a bubble, or certainly not near the end in our opinion. The drivers are the mind-expanding drug of artificial intelligence, which is allowing people to dream huge. Abundant liquidity driven by central bank cuts globally. Persistent price momentum that allows the public to think that they can make money speculating in financial assets. Unmoored fiscal policy, where governments around the world, not just in the U.S., are spending way beyond their means and plan to continue to do this in the future. And the nascent rise of animal spirits. We think this is just getting started, but this is where the bubble will really manifest in the end, if it is a bubble. We think we are in the inflation stage of the bubble, not the bursting stage. Too many people are worried about things like circular revenues between OpenAI and Broadcom and AMD and Oracle, etc. Too many concerns over overbuilding of data centers. Too many concerns about overvaluation of the Mag 7 and other AI-related plays. And too many concerns about concentration risk. Bubbles don't pop when people are expecting and looking for them to pop. They pop when central banks tighten policy. And we're miles away from that. In fact, the Fed is going to be cutting on the 29th of October. So we're not even close to that. I do not yet see euphoria relative to the AI theme or equities in general. In fact, I see more people that are concerned than euphoric. I would describe us currently in a high-risk bull market. And I call it high risk because we know there are very high valuations. We know there's concentration risk. And we know that there are many geopolitical risks. But on the other side of the ledger, we've got strong earnings. We've got rising productivity. We've got a deregulation-driven CapEx boom going on right now. We've got very strong technical underpinnings for the equity market. And of course, we've got Fed cuts coming soon, and we think there'll be more to come after October, probably another in December. So our advice to clients is to participate but diversify, rebalance, remain at your target weightings for all the asset classes, but especially equities. So don't get way overweight equity here at this stage. Don't chase the bubble. What are we doing here at our firm? We're shading more away from the cap-weighted S&P toward the equal-weighted S&P. We're allocating more to small and mid-cap equities, which have underperformed for a generation and are much cheaper. And by the way, may have more upside to easing Fed policy. We're allocating more to developed international markets, which have underperformed for 15 years and are now outperforming. We like EM equity and EM debt. We like credit, especially private credit, which is deeply out of favor. And we like some areas of the commodities markets. So stick with the program. Gradually allocate to out of favor alternative assets and out of these very popular and highly embraced public market assets. Would you rather own the S&P 500 at 24 times forward earnings, or would you rather own middle market private equity at 7 times EBITDA? I know which one I'll choose, even considering the illiquidity of the latter. So you can read our publication, In the Foothills of a Bubble, on our website at capitalcreek.com/market insights. That tab is in the upper right-hand corner of the page. Now, JP Morgan earnings. It is impressive when you see an organization of this scale produce this kind of growth. Third quarter 2025 revenues were $47 billion, up 9% year over year. 9% on $47 billion is a lot of growth. Earnings were printed at $507 versus $483. Didn't matter. Solid beat was not rewarded. The stock went down anyway. But I was most impressed with a 20% return on tangible common equity. Let those numbers sink in for a moment. 20% return on, numbers that big? That's quite something, and reinforces my opinion that Jamie Dimon is the greatest banker of our generation, possibly the greatest banker since JP Morgan himself, and is just running a large organization very well. I'll say on the other side of that, Jamie Dimon is not a good forecaster of interest rates. He is not a good forecaster of digital asset prices. And if he were a trader at his own bank, he would probably not continue with employment. But that's not what he's doing. So I don't listen to his prognostications about markets. What I'm impressed with is how well he runs his bank. Strong earnings are being driven by higher markets revenues. So markets are good, trading's good, higher AUM fees, investment banking transactions are very strong, payments are very strong, and strong net interest income despite falling rates. Importantly, the CFO said on the call, consumers and small businesses remain resilient based on JP Morgan's data, and they have extensive data on probably 80% of the consumers in this country. Credit metrics, including early stage delinquencies, are stable to slightly better than expected. That's good news. IPO pipeline, very robust. The issuance window is wide open. That tells me liquidity is abundant in the marketplace, and nothing is more important to asset prices than liquidity. Equities business up 33% with robust action across the platform. JP did admit that they got stung by Tricolor to the tune of $170 million, but they had no exposure to First Brands. And an organization this big is just going to probably have some exposure to almost everything. But they came clean about it, and $170 million is almost nothing for JP Morgan. I thought the most interesting comment of the whole call was they don't want to buy back their stock here. You almost never hear a management admit that, and kudos to them for being forthcoming. The stock declined as a result, I think. That's the main reason it went down on the earnings beat, because it implies overvaluation. They say they would rather lend in the real economy than buy back their stock. I applaud them for that. And as far as the labor market is concerned, they describe the environment as a low hiring, low firing environment with no tipping point in the data. They see no sharp deterioration in the labor market. I think that's an important point to gather from that earnings call. Now, we were privileged enough to attend the Fortress Credit Conference this week for 2 solid days. I'm impressed with this organization as they focus on value, relentlessly focused on protecting the downside, and they intensely monitor positions loans once they put them on their books. And they do a lot of work before they put any loans on their books. The timing of the conference was perfect amid pervasive bearishness toward private credit, which I think is mostly misplaced. As I said, Fortress protects the downside through structuring, through lending against high-quality real assets, deep risk mitigation team, and this team presented to us for a good bit of the conference. I was very impressed with what they do. And no wonder they're one of the best in the business at recovering capital when loans default. They're highly selective about who they lend to and how they do it and how they structure it. They mentioned there's a big opportunity in commercial real estate with a wall of maturities hitting in 26 and 27. There's going to be a lot of opportunity for them to lend into that. He spoke about direct lending because it's become more competitive. They're increasing their selectivity in this market. They're avoiding these intensely competitive deals. They just rather sit on their hands than make unattractive loans. Applaud them for that. Here's an important point about the overall portfolio at Fortress. They feel very good about the health of their portfolio. So this is refuting some of the fears in private credit. 9% revenue growth for that portfolio, 50% LTV. They remain hyper-focused on tariff and cyclicality risks, but no material headwinds have been observed to date, according to them. However, it's too early to call an all clear on tariffs, in their opinion. And we agree with that. We think there may be a delayed response to the tariffs. A common theme with Tricolor and First Brands, according to Fortress, is there was just too much capital and not enough vigilance on the part of underwriters. Fortress passed on Tricolor and First Brands, so they have no exposure there. Those borrowers just simply did not meet their criteria for lending. And when you boil it all down, they said there's no systemic risk in public or private credit today. That Tricolor, First Brands, and some of these other situations are not indicative of a systemic problem. And by the way, JP said the same thing. So two very highly credible sources have told us not to panic about credit here. And I agree with them. Now, I think returns may come lower in credit as the Fed continues to cut rates. Money is becoming easier at the margin. It has been a lender's market since early 22. It still is, but probably less so going forward. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.